Hello, Sheba.
Hey, hello, how's it?
Good, and you, man. Happy birthday.
Thank you, man.
Hey, it's nice to have you with us on your birthday, man.
Yeah, we didn't miss this one, eh?
What a treat. It's got to be a blessed and lovely day, Sheba.
Thank you so much.
Happy birthday, Sheba.
Yeah, Sheba. He's on the phone there taking a birthday call, Andre?
Yeah, looks like it.
See, the birthday boy is all dressed up as well, in his suit and tie there. Well done there, Sheba.
I think he's going for an interview.
Let's hope not, eh?
Good.
Well, ladies and gents, let's kick off. We've got quite a bit that we'd like to share with you from the C-Team side this morning. It's really great to be with all of you again, and I'm very happy that the sun is shining outside here in Durban. To all my fellow Durbanites, I do hope and trust that your houses are standing and your driveways are cleared of mud. I think if you're living in Durban and you've got a roof over your head, dry clothes, electricity and water, you are truly blessed today.
Yeah.
Thank you guys for all of you who's joined us. We want to take you through a couple of things today, and I think many of you know that Seed is a multi-manager, and we've got a range of 7 unit trusts that we manage. And these funds are obviously listed on all the major local and offshore investment platforms that we as South African advisors use. And many of our clients are currently invested in these unit trusts. What you may not know is that, yes, we are a leading multi-manager in SA, but we're also so much more than that. And we want to show you a picture that just gives you an overall glimpse of all the areas of Seed expertise that are available to you as our financial advisor partner. Lisa, it's not moving on my side. Yes, there you go. If you can maybe just go on to the next one. Thank you. So, as a multi-manager, maybe before I do that, for the latecomer Sheba, happy birthday. We wish you a very blessed year ahead, man, and I hope you're going to have a wonderful day. So, as a multi-manager, we've got core expertise in the 3 areas that most of you are very familiar with, and that's the burgundy one there, the orange one and the green one, asset class valuation, fund manager research and portfolio construction. But what you may be less familiar with is the light blue block. We've got roots going all the way back to 2002 when Ian started this business as a wealth consultancy business, really focusing on helping you to build that amazing investment practice. So we really want to invite you over the next couple of months with these Seed morning coffee sessions to journey with us. And in addition to our normal market and fund updates, we want to take you through some very practical case studies on the various value addeds to your particular business. So for today, as part of showcasing our fund manager research piece, Tawanda will take you through a case study on our evaluation of an income fund that many of you use. This fund's not on our shortlist currently, and that's a SaaS fund income fund. So T-Man will just give you a real sense of how he looks at that fund and some of the pros and cons. And then as part of that light blue investment practice build offering from Seed, I will take you through a case study on an investment book optimization that we recently did for one of our advisors. But I think first, let's kick off with what's happening around the markets and what's driving markets and asset valuations. So we want to take you back to 2 key slides that we shared with you last month, just to discuss some of the risks first, and then also maybe look at some of the opportunities. So in this slide, you will see that we've marked with arrows there whether we believe that the risk around this particular subject has gone up and down. And you will see that unfortunately all the arrows are pointing up. So since we spoke to you last month, we believe that the risk around global equity and bond markets have increased, the risk around global inflation, monetary tightening around the globe, as well as geopolitics. So we do believe these risk factors around global equities have increased, And as a result, our global allocation to equities has been reduced to neutral from overweight. We do think it is still possible that equities can outperform bonds over the next 12 months on the global landscape, but that the risks to that are rising. Our BCA partners are recommending an overweight position in the more defensive healthcare, consumer staple kind of shares. In other words, shares that are less sensitive to the impact of the economic cycle. And then looking on the bond side, the key 10-year US bond yield continue to move higher as the outlook for inflationary pressures remain elevated, touched on 2.8% level, and it's just threatening to break out of that secular downtrend that's been in place since literally 1987. So that is one we're watching quite closely. And then moving on to global inflation, the real culprit in an equity turmoil has been inflation. So US and global inflation remain elevated. In fact, it's at multiple decade heights. So the March numbers for the US came out yesterday at 8.5%. Now remember, they are targeting 2%. So at 8.5%, it's more than 5 times the long-term target number. The market expected a level of 8.4, so the 8.5 was very close to that, and we saw quite a positive reaction from the market yesterday on the inflation news after a couple of negative days in the market. So the war in Ukraine has heightened the odds of higher for longer inflation, sort of the tighter for longer monetary policy, and of course the risk of recession in the US and Europe. And on the back of this, it looks like stagflation is becoming a real risk. So just a recap on Economics 101, for those of you who've forgotten what stagflation is. It's an environment simply where your economic growth is slowing down, employment is slowing down, while inflation is running very high. And then moving on to central bank policy. So the US Federal Reserve will continue to increase interest rates given this high level of inflation and low unemployment levels. So the Fed has potentially, one could argue, been behind the curve. And in retrospect, maybe they should have started hiking rates last year already. So the market is pricing in multiple hikes. In fact, markets are pricing in just short of 3 50 basis point hikes by the Fed. So the BCA that we get our research from believe that's a reasonable estimate, and that the Fed is unlikely to hike more than what the market is currently pricing. So one could argue a lot of this is currently sitting in market pricing. And then on the geopolitical side, it's now 49 days since Russia invaded the Ukraine. It remains contained geopolitically, that conflict. That sort of moves now to the eastern side and more sort of the coastal region. And although the odds of a real escalation is one could argue is low, the conflict may become a war of attrition lasting many months with an effect into the second half of 2022 and possibly into 2023. But the economic consequences continue to be felt across the world. Given that Russia and the Ukraine are exporters of key products, thinking particularly commodities like wheat and resources, it is having a global impact. It adds also to the reversal of globalization. It increased that inflationary pressures we just spoke about. And as part of that overall themes for the last years, especially since the COVID crisis, the escalation of nationalism and populism, which has reared its head and is definitely, even before the invasion, was two of the key themes for this 2022 that we're in. So that's it on the risk side. Everything's got to be balanced with some opportunities. So if we look at an update on the opportunity slide from last month, so commodity prices been positive, particularly for us. So the war in Ukraine has increased food and industrial metal prices and will further snarl the global supply chain at a time when global shipping costs has already been rising because of China's Omicron-related lockdowns of major economic hubs. Currently cities like Shanghai and Shenzhen remain in hard lockdown. We had a very interesting update from Leanne, who manages our China portion in the Balanced Energy Global Fund yesterday. And that's all impacting this bottlenecking in global supply. So commodity prices are sharply higher, has been sharply higher, and this is very generally positive for South Africa as a commodity exporter. Obviously, while the higher oil prices has been a little bit negative. Interesting, in the first couple of days of April, literally all asset classes was negative up until yesterday, including oil. So palladium is up 28% year to date, iron ore 26, gold 147. And as we've seen, that's really helped the rand to remain that relative strength, trading around the 14, 15 mark for the bulk of this first part of the year. And then gold has played a reasonable hedge through all this market turmoil. It's currently trading just below the $2,000 level. And yes, while evaluations has potentially increased as asset prices has come down, the risk may be more elevated. And that's why we think a more neutral approach to global asset allocation is required. However, it's not all doom and gloom. There's really some positives still specifically underpinning the real economy. So that's a sentiment around the booming labor market in the US. Really hard to find employees in the US with the market just about saturated. Very healthy consumer finance in the US, and then robust corporate capital spending plans, which are both positive. Of course, it's that balance between the gap between PPI and CPI, where you've got a very high producer inflation coming through to businesses, and they don't always have that pricing power flexibility to pass that on to the consumer. So there is a risk, and we've seen that in China starting to happen now, where you might see margin compression, and that obviously will impact company earnings and then filter through negatively into business valuations. So on the SA side, from a bond perspective, the firmer commodity prices is very positive for our fiscal position, also for our tax collection, and that fundamentals is essentially backing our bond market. So despite the global bond yields moving up, South African bonds has remained reasonably insulated, and also being seen kind of as a safe haven, which contributed to the relative strength of the rand. And then, as we saw, Moody's actually put us on a neutral watch recently, up from negative. So that's it on the sort of opportunity set. And then just to give you a sense of that, how that filters through in our actual asset class valuation. So a quick summary on that. We've moved local bonds and equities from a moderate to a strong overweight. Yes, the local story is a strong commodity story. And for interest sake, over the last 5 years, the SA equity market has really been driven by the rise in commodity share prices. So if you look at what the industrials have done over the last 5 years cumulatively, it would have given you a 31% return. The financial index cumulatively over 5 years, 51%. Any guesses on what resources have done over the last 5 years? That's up 220%. So phenomenal resource run that we've seen over the last 5 years on the JSE, particularly in the second half. Having said that, the financial sector really has done well so far this year, and it's up 16.5% year to date. And then on a global side, we've upgraded global FX cash to neutral, and we've moved global equities back to a neutral position. So that's it from my side. Happy to take questions, or otherwise we can do questions at the end. What we like to do now is just give Tawanda the microphone to talk to you about that case study on the Sasfin Income Fund. Thanks, T-Man.
Thanks, Adriaan, and good morning, guys. I just thought that so that I can show you what we do on the manager research side, just to give you an example of one of the funds that probably is doing very well in the market, probably a favorite for many. But obviously, we don't have this fund on our normal shortlist that we send to you on a monthly basis. So I just thought I'd use that as a case study for you, just to see some of the work that we do on the manager research side. So if we move on to my first slide here. So the fund that I'm looking at is the Sasfin BCF Flexible Income Fund, which screens very well quantitatively. I think if you look at the history of this fund since it started in 2015, it's been an absolute star. It's delivered pretty fantastic returns. So even if you look on a quantitative basis, it screens very, very well because of those great historic returns where it's outperformed peers within that multi-asset income category. It's even won Raging Bull Awards and a Morningstar Award just on the basis of that outperformance. So in terms of delivering good returns, this has historically been a really good fund in that multi-asset income category. But what I would like to highlight first, just on my next slide, is that this fund is actually not just is not an ordinary multi-asset income fund. So if you look at the chart that I've got here since the inception, so what this chart shows you, it's a risk and return chart. So on your vertical axis, you've got the return, and on your horizontal axis, then you've got the volatility of the fund. And what you can see, the blue dot that you've got there, that's the Sasfin Flexible Income Fund. And what you can see is the return has been exceptionally good since inception. And what I've just compared it to there is the average of the multi-asset income. And I've got quite a few gray dots there. That is the multi-asset income peer groups. So you can see that the return has been much higher, but then the volatility similarly has been much higher. So it's not an ordinary multi-asset income fund in the sense that it actually takes on a little bit more risk than your conventional multi-asset income funds. Whenever you listen to sorry, if we just go back to that slide. So whenever you listen to the guys speaking, they always speak about how they're aiming to outperform bonds, obviously with low volatility. And the green box that I've got there is just your all bond index that shows you that they've actually been able to outperform the bonds. So with much lower volatility than the bonds. So this fund actually falls somewhere in between a multi-asset income fund and a bond fund. So somewhere in between. So not really a conventional multi-asset income fund and not really a bond fund, but somewhere in the middle. If we move on to the next slide, just if we look at a second risk measure, this is just looking at the drawdowns that you can potentially get from the fund. So here I've compared it to bonds again and the multi-asset average multi-asset income fund, which is in the red line. And as you can see, it falls in between. So it's got that fund has got much larger drawdowns than a conventional multi-asset income fund, but obviously much less drawdowns than you would get from bonds. So what I'm just trying to highlight here is the awareness that when you go into a fund like this, you are taking on a little bit more risk than a conventional multi-asset income fund. Obviously, the returns have been great. If you look at the returns, the returns are great, but you need to be aware that it is a slightly much higher risk than your conventional multi-asset income fund, although it is less risk than bonds. So if we move on to my next slide, this is just to say that, okay, I have said that they're taking on more risk than your conventional multi-asset income funds, but the fact that it takes on more risk is not necessarily a bad thing, for as long as investors are being compensated for the risk that is being taken. I suppose that is what investing is about. You need to be rewarded for the risk that's been taken. So it's not necessarily been a bad thing that a little bit more risk has been taken, but you need to be aware that there's more risk, and the reward that has come so far or historically is because of that additional risk that's been taken. So this is a big focus on the quantitative side. We're looking at the returns, we're looking at the risk, but in addition to looking on the quantitative side, we look at qualitative factors as well, just to understand, because what's history is historical. That's what's happened in the past. What we're concerned is about what's going to happen in the future, and we try and predict what's going to happen in the future. It doesn't just come from what's been delivered in the past, we want to be reasonably comfortable that going forward, either similar or better returns can be delivered in the past, which is why we look at these qualitative factors. And here I've just highlighted people, philosophy, and process. I think every time that I've gone through our manager research process, I've gone through some of these qualitative factors just to mention why it's important to look at some of these things. And why I highlight people, philosophy, and process in this particular case is because the manager that was the key manager that was responsible for this philosophy and process for the Susfin Flexible Income Fund, that is Phil Bradford, actually left Susfin. This was at the end of 2020, and went to join Portfolio Matrix as the head of investments, and then obviously set up a similar strategy to the one that he was running at Susfin. Phil Bradford was replaced at Susfin by Arno Lawrence, who we know very well. Arno came from Ashburton, but we've dealt with him from his previous days at Atlantic and at Ashburton as well, where we've used their funds. So he's a manager that we know very, very well. Obviously, pretty decent manager as well, but he comes in with a slightly different philosophy or different way of managing fixed income assets, just based on how he's managed fixed income assets historically. So on this qualitative basis, then we see it as a gain for Portfolio Metrics, because they've got Phil Bradford who joined, and then obviously a little bit of a negative for Susfin, because as you can see it, it's quite a different strategy from your conventional multi-asset fixed income strategy. It's definitely a different flavor. So to lose the guy who was responsible for that strategy is a bit of a negative. And this is just what I highlight in this chart, that the scale has obviously been tipped onto the Portfolio Metrics side, because they've gained the guy who's responsible for that philosophy and process, and he's running a similar strategy at Portfolio Metrics. So a bit of a loss for Susfin, but quite a gain for Portfolio Metrics. And if we normally what we try and say is these qualitative factors can have an influence on performance going forward. And what I can say is, obviously, that Portfolio Metrics has not been there for quite a long period of time. So it's only short-term performance that we're comparing since around the end of 2020, when Phil Bradford joined them and set up the strategy. So what you can see is this is a comparison of the performance between the Portfolio Metrics Fund and the Susfin Fund. As you can see from the beginning, it's fairly similar strategies, so they've pretty much tracked one another quite closely, because it's kind of like the same philosophy and process. But in terms of the implementation of that philosophy and process, then obviously, because you've got different managers, then it can be implemented slightly differently. And as you can see from that, from the last quarter of last year, 2021, that performance started to diverge a bit, which is what I zoom into there, just to show how the Portfolio Metrics Fund is actually now started to outperform that Susfin Fund, but by quite a bit of a margin. So what happened in the first quarter this year, you've seen the income funds experiencing some drawdowns. That Susfin fund experienced a bigger drawdown than the Portfolio Metrics Fund. And in terms of the recovery, then the Portfolio Metrics Fund recovered much quicker and much better than the Susfin Fund, which obviously is still below its a previous high. So what you can see from that is probably an implementation of a similar strategy, just by different managers, and they would see why would favor the guy that was initially responsible for that philosophy and process, because he knows exactly how to implement that strategy, as opposed to, let's say, a different manager who still follows the same philosophy and process, but also comes with his own thinking when it comes to managing fixed income assets. So maybe that's why you see that divergence in the performance. So just to go to my concluding slide, Obviously, you can see that the strategy is a bit of a spicy strategy, quite different from your ordinary multi-asset income fund, as I've shown. It tends to have more volatility and larger drawdowns, but as history has shown, the return has so far been good. But it does, because there's more risk that is being taken, the return profile isn't necessarily always going to be the same going forward. You can experience more volatility, you can experience more drawdowns, so you just need to be aware of that. If you choose to go a fund for a fund like that, then maybe because of the potential drawdowns that you can get, you might have to consider blending that fund with a lower risk fund. The second point that I've got there, obviously with Phil Bradford's departure to go to portfolio metrics, that leaves Sasfin slightly qualitatively weaker. I think they have still been consistent with that philosophy and process, which is a positive. But if things were to go wrong within the market, then it might be easier for them to deviate away from that strategy, which is what you invest into when you buy into a fund like that. It's possible that they can deviate from that strategy since they've got a different manager who comes in with a different type of thinking. So slightly qualitatively weaker, and as we've seen, the performance has diverged a bit in the recent past. Obviously, I've highlighted Phil Bradford moved to portfolio metrics, which then makes them slightly stronger just on a qualitative basis, just in terms of managing a strategy like this. He's obviously, if we were to go for a similar strategy, then he is our preferred manager because of that consistent philosophy and process, and obviously knowing how to implement that philosophy, how to implement that strategy. And we have been he's a manager that we know very well, even from his Sasfin days. And obviously now that we've been engaging with him when he was at Sasfin for potential inclusion in our funds, we engage with him at Portfolio Metrics, as that's a fund that we also look at for potential inclusion in our funds. So if we look at that strategy, then we would say that Phil Bradford is our preferred manager for a strategy like that, and Portfolio Metrics in that sense is slightly stronger on a qualitative basis than Sasfin, and quantitatively as well. We can see that they've started to outperform the Sasfin fund on that strategy. So that's just to highlight some of the quantitative and qualitative factors that we look at, and this is specifically looking at a fund that we don't have on the shortlist, but just to also show you that we look at all these funds, all these strategies. They might not be on the shortlist, but there is normally a reason why we don't have them, and in this case, it's a slightly riskier fund, and obviously there was a big qualitative change within that. And that's it from my side. Adriaan, I don't know if we're going to handle questions right now, or we can do those at the end of the session.
Yeah, guys, you're welcome to put up your hand at any time. Lisa will flag it and raise a question, or you can post it in the chat section. But there has been some questions and also some answers, so you're welcome to look at that while we talk. But T-Man, thank you for that glimpse into your world, what you and the Seed Research team are busy with on a daily basis. And we've been having these very engaging workshops with a number of you guys, where you might have some funds that you ask us why they're not on a shortlist, or you prefer to use some of these funds in conjunction with the shortlist. And we're very happy to have those engagements with you, just share our collective knowledge bases, share insights. We understand that you as an advisor, your primarily focus is to understand your client and your client's needs across the whole universe of risk, medical aid, short-term and investments. And you don't necessarily have the time to do all the research, but you've got a partner in Seed who have got a dedicated research team headed up by Tawanda, and that's what the guys do on a daily basis. And we're certainly happy to share some of the insights and debate some of the issues with you. The next piece we want to just show you a case study on as part of the investment practice built pillar. And that particularly talks to the book optimization process that many of you have engaged with us. And if you are a subscriber to Seed Analytics, then you obviously get your monthly book report, which is your set of management information documents. This is taking that document to the sort of the next level, really analyzing both the risks in your book, but also the opportunity set for you and your clients in your book. And we then take you through that case study. Together we identify some key action items, and then we start implementing around that. So just a particularly case study of a book that we did very recently for one of our partners. And I'll just take you through the different sections just to give you a sense of what we do and what are some of the insights that we derive from this process. So you will see that this is a 210 million book with 301 clients. You will see that this book started last year on 180 million. It grew to 210 million, kind of a 17% growth, which is good. It's obviously a mixture of some market growth and some new clients. So you guys might have your various platforms that you like to use, be it Allen Gray, 91, Glacier, or Stanlip, irrespective of the number of platforms that you trade on, local and offshore, and which process you like to use. We could do this report for you, provided that you do subscribe to the Seed Analytics book report, because obviously we need to scrape this data on all the various platforms to be able to give you this report with the underlying insights. So this particular advisor's book that we're having a look at today trades mainly on the Stanlip and Liberty platforms, with 53% of the assets on the Stanlip platform and 47% on the Liberty platform.
Thank you. That's you, Harvey, the guy for the game.
Frank, I think you wouldn't mind just muting there. Thank you. The next section that we look at in the report is the top funds in your book. And the report gives you a very useful snapshot of all the funds that's got a larger than 2% allocation in your overall book. So you will see in this particular instance, the top 3 funds used are the 91 Opportunity, Allen Gray Balance, and Seed Balance. So those are all funds from the Seed shortlist. So well done on that to this advisor. The report also gives you insight around your AUM per risk category, with the advisor clearly doing a lot of retirement planning, as you can see on the right-hand table there. And from the very high allocation to that multi-asset high equity space or the balanced fund space. If we then look at the fund concentration across the overall book, and this is where it starts getting really interesting. So you will see on this book, 90% of the assets was concentrated into the top 31 funds. Now that's a very good, and I'll elaborate on that just now. But if you look at the final 1% of assets, that's spread across 40 funds. And that's potentially where the risk sit for you as an advisor, because that's maybe a client that's in a fund that you did 5 or 10 or 15 years ago that was the flavor of the month back then. The client is still stuck in there, and that has introduced unnecessary risk for you and for the client. So that would be an area that, from an action item perspective, that would be one of the first areas that we then look at to consolidate that area into one of the more used funds and better understood funds, and hopefully one of the funds that's actually sitting on the shortlist. If we then look at the number of funds per risk category, so this advisor has made use of a total number of 113 funds over the different years. So any guesses on how many funds are on the Seed shortlist? I'll put you out of your misery. There's only 19 funds on there. So with those 19 funds, as we said many times in the past, that's really all you need to build a wide range of bespoke client portfolios locally and offshore. So to make it more practical, if you maybe add a couple of passive funds, a few more direct offshore funds, then let's say you end up with a universe of 30 funds maximum. And this is, by the way, also kind of the number of funds that we use in the Seed quasi-DFM solutions when we partner with you to build bespoke client portfolios, Miguel and I. So if you remember back on the fund concentration piece, 90% of the assets was concentrated in 31 funds. So that lines up very nicely with this philosophy of potentially a maximum of 30 funds. And one could argue that that other 10% of the book over time could be consolidated into that 31 funds that 90% of the assets are in. And when you then look at the different underlying sectors, you then start identifying the problem areas. So if you look at the global section, using 30 funds in the global section, 24 different balanced funds, 17 different local equity funds. So clearly, maybe an opportunity for consolidation there. In fact, our research has shown us, and this also reflected in our shortlist recommendations, that you do not need more than 3 to 5 funds per risk category to give you and your client the optimum benefits of diversification. In fact, using too many funds ultimately start diluting the benefits of fund manager diversification. So a good risk management measure would be to consolidate all of these categories into top 5 or 6 funds per category, aiming to certainly have no more than 10 funds, that little red dotted line that you see there per category. The next piece of analysis is also very useful. This part of the book analysis is a function of you, the advisor, loading a strategic asset allocation for each of your clients on the Seed Analytics platform. And it really helps you with your long-term client investment management journey. So what we're showing you here is essentially a age risk funnel with each of the red, green, and orange dots representing one client in this advisor's book. So it gives you at a glance a view of 2 risks. One, clients who are potentially exposed to too much risk. That's the red dots at the top. And that's something like that 74-year-old client that's sitting there in 100% equities. And conversely, it also shows you clients through the orange dots who potentially should have higher exposure to risk assets. So that's something like that 41-year-old sitting there that's 100% in cash. Now, there may be very valid reasons why these particular clients are sitting with that particular asset allocation exposures, but it gives you the opportunity to either confirm that it is correct or to change that to a more appropriate asset allocation for the client. It might be that 41-year-old was put into money market as a parking bay and the world's moved on and both you and the client have forgot to move their clients and it's 10 years later. And that's a potential risk for you and the client, obviously. So this is actually looking very good, this particular book. 73% of the clients are within the bounds of that balanced exposure. There's a few older clients, 8% of them, that's got potentially too much risk, but not too much out of that boundary settings, which is actually a great alignment. And then if we move on to the next one, which is the overall client positioning. So we call this Miguel and Cora and I, the Sleep Easy matrix. So essentially, it plots on the x-axis your book exposure to the seed shortlist. And ideally, we want that to be above 70%. That's sort of a good indication. And then on the y-axis, it looks at the real investment compliance of your client with their strategic asset allocation strategy that you've loaded for them. And there we're saying we're aiming for 80% above compliance. So essentially, if all your clients are in that green block on the top right corner, then you can sleep very peaceful at night, knowing that, number one, your clients' investments are aligned with the investment strategy. And number two, all your investments are according to the seed shortlist. So you don't have to worry about the portfolio manager valuation like Tawanda's just shown. I don't know how many of you that are invested in a SAS income fund, flexible income fund, knows that the fund manager has actually moved in 2020 already. Some of you that we've spoken to certainly weren't aware of that. Yes, you've got a substantial allocation to that fund. So when you're in that green block, you don't have to worry about that. Seed is taking care of that for you. And then, of course, the red block identify maybe a potential risk area for you. And in terms of the action items, that would be an area that we focus on. So you can see in this book, very few clients in that red area. So potentially something this advisor could clean up quite easily from a risk management perspective. So, and then moving on to the next section of the report, it's a couple of pages long. We then list for you all your funds that you use. And those of you who draw the monthly Seed Analytics book report will be very familiar with this. So this is where we then look at your book alignment to the standard seed shortlist. We categorize your funds into the different risk categories, and then we give you feedback. So for example, in this particular instance on income funds, a lot of use of a standard income fund in this particular book, and perhaps there's an opportunity to blend with 2 or 3 other income funds that's on the seed shortlist. If we look at the multi-asset high equity funds, a lot of use of the shortlisted balanced funds, which is great. But as we said earlier, making use of 24 different funds. So definitely an opportunity to consolidate into top 10 or even 5 or 6 where possible. In this particular instance, a number of Excelsior and Liberty on-balance sheet funds making up the tail end. And then if we look at the equity fund section, and you don't have to worry about all the details, I'm just giving you a sense of actual case study and some of the insights from this book. So if we look at the equity portion, we found a huge concentration in passive top 40 tracker from Liberty. There's 12 funds there that's sitting with an AUM of less than 700,000 that potentially could consolidate. And then 2 recommendations on the equity piece of this book. One is to perhaps either consolidate everything into that Liberty top 40 tracker to keep things simple, or secondly, maybe introduce Fairtree equity as an active manager, got an outstanding track record, and giving the clients the opportunity to diversify between active and passive local equity managers. Then on the global side, good use of the shortlist funds again, but many smaller funds that can be consolidated into that top 3 sort of global funds in that space. And then some insights, just very lastly to share on this particular book analysis, is that we've identified there's an opportunity with the legacy book. And what we mean by that is we filtered out the on-balance sheet investments. In this instance, sort of Excelsior and Liberty funds. For some of you, it might be Old Mutual, Sanlam, or Discovery on-balance sheet products. So in this book, that came to 16% of the book. And that's a very good place to start generate more annuity income for you as the advisor. Very often on those old legacy products, you were not able to charge an ongoing advice fee. Often the costing for the clients are quite high on those legacy funds, and the underlying selections are very limited. So it is sometimes an opportunity when you look at those legacy funds where you can win, the client wins, and everybody's sort of better off by putting the client in a better solution. So after we've done this whole book analysis, we then sit with you and your PA, and we take you through the analysis, kind of like what I'm doing now. We then identify sort of the key risk and opportunities that you want to address first. And then we typically work on an 80-20 principle. So we identify the biggest risk and opportunities. We rank those from clients from big to small. And then we provide you and your client with a list, actual client list, where you can then start implementing. And typically we take it 5 clients at a time. So it's not overwhelming. It's constructive for you and the clients over the period. It also does offer the opportunity for bulk moves across funds, and we've done that with a couple of you, where you just on a bulk basis realign your clients to either a more cost-effective or efficient fund or portfolio. So we just wanted to give you some insights around a real practical case study on the book Optimisation. And like I say, please, the offer is open to all of you to take us up on this and to make use of this. We will very gladly partner with you on this journey. Guys, and that's it from us at CT. We're very happy to take any questions. If there's any questions from any of you, you're welcome to ask those. Shona, I see you've joined us. If you've got a comment, you're welcome to also share with us. Nice to have you on board.
No comment, Adriaan. I think thanks to you and Tawanda for taking us through these. Really, how we can help. We're here to help. We're here to serve. And I know you're doing a lot of work in the background, you and Miguel, with a lot of the advisors. And I think a lot of you also have signed up for the book reports on the new model. So there's going to be a lot of information coming away probably over the next couple of months. If you haven't previously received your book reports or the statement, client statement, there's a lot of information going to be coming to you in the next couple of months, and we have to help. Give us a shot, and you saw what Adriaan's taking you through. I think it's really valuable, and it just cements your practice. It makes it more compliant, and you can rest easy, and that's what we're here to do.
Thank you for all the comments there, also from Robin and David and Rowan. Appreciate that. And guys, yes, please reach out. Stay safe and dry, and look forward to engaging with you guys again next month.